why I started this podcast is because I'm trying to learn as much as possible so I can get to that financially independent, or I can, have different perspectives on business and just expand my network overall. But so that's an interesting perspective of, that it doesn't quite stop there. It's almost just like a stepping stone for the rest of it. But before we go too much into the rest of it, how did you get to that financially independent spot from when you were a software developer? Like, when did you get that job, and then what steps did you take to get to where you wanted to be?
Yeah, so it was an interesting journey. Some of it by accident, right? One of the things that I firmly believe in life is that people always argue between, or is it luck or is it hard work? And really, it's a mixture and a combination of the both. It's like the hard work to be prepared for the situation, the luck that you will get in your life, and to be able to take advantage of it. Because everyone has lucky moments. They just don't either recognize them, or they're not prepared enough to take advantage of them and to do the work required to maximize them. There's actually a really good book that really talks about this called Thinking in Bets. It's by Annie Duke. She was a professional poker player for a while, and her whole mindset is very similar to the way that I think through things in terms of that. And the reason why I say it that way is because I had a lot of luck, and I had a lot of times that I was prepared for luck, and a lot of missed opportunities as well. But when I started out, one of the lucky things that happened to me is being in software development during the .com craze. I got this crazy call from a company that wanted to hire me as a software developer when I was 19 for $75 an hour with like some per diem. This was in California. So it was basically the equivalent of making like $170,000, $180,000 a year. Right. Jeez. And this was just, I packed up all my stuff and I moved to California, like it put it all in my Geo Metro. And I had bought a house actually at 19, my first house, but I wasn't smart. I just bought it because I didn't want to pay rent. I had no idea about real estate investment. I just didn't want to pay rent. That's all. That's as far forward thinking as it was. But so, it turned out that I ended up leaving that house and renting it out to a friend, which turned out to be a bad choice, but it got me on that path. And when I got to Southern California, thinking I was rich, 19, and I didn't really deserve this job. I wasn't really qualified for this job, but hey, I started reading as many books as I can to try and become qualified for the job so I could, pass for the job, which I did. And when I got there though, I started running the numbers in my head, and I was like, okay, how long before I'm rich, right? And for me, rich was be a millionaire, right? That's rich. Like, so I did the math, and I was like, okay, if I'm making like 170,000 a year, I have taxes and stuff, so maybe I have like 140, 130 left, and then I could live off of like 30K a year in Southern California. I was sleeping on a mattress on the floor, and I was buying macaroni and cheese dinner while I was making $170,000 a year, by the way. So that was the plan, and the plan was I was going to save $100,000 every year. And then I did the math, and I was like, well, how long before I become a millionaire? And then at first I was like, well, 10 years. Wait, that can't be right. And then I was like, whoa, inflation. So like 13 years, maybe 14 of saving 100,000. Can't lose this job. Sleep on a mattress on the floor. Wow, this is crazy. I was like, there's no way. And then I was like, okay, well, what if I invest the money and make like a nominal return? Nope, still, it doesn't like in a 10-year period, making even 7% return, it doesn't really cut a lot off the sentence, right? You're still, busting ass and saving money for that. So it's like, how the hell does anyone, who makes more money than me, right? Like, at 19, this is my thoughts. I'm like, let's say I made 250,000. Does this change the situation much? No, it doesn't. And that, like, who's going to make that as a software developer? That would be unheard of as a software developer. Now you could make that as a software developer, but back then there was no way, right? No one was making that. So I said, well, how do people actually get rich? This doesn't make any sense. Like, if I'm making the most money that I could, at the earliest age, and it's going to take me over 10 years to do it. And then a millionaire is not even rich. That's not even rich. That's just like, entry level. So I started looking, and I found that it was people who invested in real estate, that like 90% of the wealth created in the United States is from real estate. And it's kind of funny because this was 20 years ago. I stumbled upon Donald Trump back then, like 20 years ago. I was like, damn, this guy knows what he's doing. Started studying some of his stuff, right? Before anyone really knew, who he was. And, like him or hate him, he definitely made a lot of money in real estate. And that was one of the models I followed. But, I started reading up on that. I found this really good book by Gary Keller called The Millionaire Real Estate Investor, still the #1 real estate book that I recommend today, because it had the charts in there. It was what I was looking for. And when I looked at those charts in that book, I was like, this is it. I was like, damn. I was like, if I buy a house every single year, okay, in 15 years, I'll be rich. You know what I mean? Like guaranteed, I'll definitely be able to retire. And in 30, for sure, just buying houses and just paying off the mortgages over that period of time. And so that's what got me into investing in real estate. And so eventually I lost that software development job, you know, the bubble burst on the .com. I still had it like some decent jobs, but eventually I hit a point where I couldn't get a job more than like 80K a year as a software developer, but it didn't matter because I was taking all the money I was making, I was buying a house every year. And then I started buying some duplexes, some fourplexes, and I had the plan in my mind because I had those charts. I knew what was going to happen, and I knew how I was creating my money in real estate. And I knew, and I had a chart of my net worth, and I could see what my net worth was, and I could see what my cash flow and passive income was. And so I continued as a software developer. I ended up having another kind of lucky break that happened, which was that I started a software development blog called Simple Programmer, and it got popular. And I ended up getting on a bunch of like popular podcasts for developers, started to build a brand for myself and name. And I got some opportunities. I ended up building an app that did okay in the App Store, but I got an opportunity from that app. This company called Pluralsight contacted me and they said, hey, you know, they were just starting out. Now they're $1 billion company. And they said, we're looking for authors to teach people how to create Android apps. And we saw that you just created one. You know, there was a guy that was local in my town that had worked for that company and was an author. And so I recorded courses for them, and I saw the opportunity. See, a lot of people who were authors at the time, they made like one course or two courses, but I made my first course, and my first course I made $8,000. They paid me. But if it was certain length and time, they would pay you royalties as well, like an author. And so I got my first payment for my course. It was like $8,000. Like, wow, that's crazy. That's good money. And then 3 months later, I got my first royalty check, and it was $5,000. And then that's when the bells went off, and I was like, whoa. I was like, this is the best opportunity I've ever had in my life. And so I just started making course after course after course. Ended up making over 50 courses for them over the next 3 years. And I was getting royalty checks of like $150,000 every 3 months. I was the most published author on their platform. Like no one had anywhere close to the number of courses. And I mean, I was working like a dog, like 80 hours a week, you know, for 3 years, but this was my ticket. And so I funneled all that money into real estate, and that allowed me to accelerate my retirement plans. And by the time I hit 33, I had the point where I'd paid off a huge amount of property. I had a bunch of properties that I was making cash flow on, that I had mortgages on, and my net worth was, you know, somewhere around like $3 million at that point. And I was like, okay, this is, you know, this is it. I've made it.
Whoa. Yeah, that's pretty crazy. So not to get too much into detail, but earlier on with your real estate, how did you go about buying a home a year? It sounds like you're taking on quite a bit of or for most people would have to take on quite a bit of debt to do that. Is there like a risk analysis process, or do you put like a really high down payment? How does that work? How did you start that?
Yeah, so some of the things I did early on maybe were not the best. I don't know. I mean, when you don't have a lot to lose, like leverage really doesn't hurt you that much as long as you can be close to cash flow positive. And in my early calculations, I was off because I didn't factor in maintenance. I didn't factor in vacancy rates and all these things. But it didn't matter because, you know, because the thing is, like, you make money from the principal pay down and also from the leverage appreciation and the depreciation in real estate. So when it balances out, you might lose some money out of your pocket. So basically what I did was I started off and I bought a property, my second property, because I had the first property I had bought, it was like a $60,000 shack in Boise, Idaho, just to live in. You know, that was the one that was not intentional. But then when I came back to Boise after this California thing, when I was really investing, I bought one side of a duplex, like a townhouse, for $110,000, and I put 10% down on it. Okay, so I had mortgage insurance on it, but you know, I could come up with 12 or 13K to make the down payment. That's a reasonable amount to save, and so I had that, and I still had to pay some mortgage insurance on it, and so it was like it was cash flow negative maybe by like $150 a month. Not a huge deal, but when you that's just on paper, but when you look at everything and you look at the principal pay down and you look at the depreciation, it was definitely cash flow positive, right? From a perspective of the actual numbers out of my pocket, it was negative, right? So then the very next year, I bought a second property, the second side of that duplex, townhouse, and it was about $110,000 at that point too. And what I did was I actually took, I can't remember if this one maybe I just had another 10 or 15K and I put it down because I was saving, 10, 15K per year, which is, I mean, that's generally what you could do, right? Or you could put 20% down and save 30K a year. It's really what I tell most people when I talk about real estate investment. I say, first get to the point where you're making 100K a year at a job. And that's really not that difficult to do today, right? If you can become a software developer, go to boot camp. There's a lot of ways, in sales, it's pretty easy to do, but invest in yourself, invest all the money that you're making in yourself in order to increase your skills so you can make about a 6-figure income. Because then it makes real estate investing a lot easier. You don't have to, but it'll make it faster, right? So my plan was basically to just put down 10 or 20% every year. And I experimented with getting second mortgages versus PMI, knowing that I could drop off the PMI at a certain point, or I could pay off the second mortgage early. But today I would recommend most people just put 20% down. But back then I was trying a bunch of things and running a bunch of numbers. And I said, oh, what happens if I get a home equity line of credit, pull the money out of the first property and then buy the third property? And that's what I did. So I was quite leveraged on that one. But at that point, the first property's rent had gone up enough to support the HELOC, right, to get the down payment for the third property. So I just kept on kind of playing that game. I would get a bunch of HELOCs on my properties, so I would have a pool of money. So I was basically reusing the money that I was, and HELOCs were really cheap at that point. It was kind of weird because at that point, regular mortgages were 6 to 7% interest rate, but HELOCs were like 3%. And so it just made sense to like pull out HELOCs and then use that as down payments on other properties. But, I was super leveraged doing that. I ended up being okay. At one point, I think my maximum negative cash flow was $1,000, $1,500, something like that, but I was making decent money. So I knew that the math was working out. But when I advise people today, I say the safer route to do that just makes sense, that's solid, is just save up a 20% down payment every year and buy a property. And that's, if you're making decent money, you could do that. If you're not, then it could be every 2 years or so, and then you could eventually get to the point to do that. But yeah, I just don't like paying the PMI and the mortgage insurance. But I mean, it does work out, because if you're leveraged, like if you put 20% down, it's a 5x lever. So if a property goes up 3%, then you're going to make a 15% return on your money. And the average appreciation over the last 50 years is like it's between 3 and 4%. So 3 is a pretty conservative number. If you do 10% down, then it's a 10x lever. So if a property goes up 3%, you actually make a 30% return on your investment. So that's, there's very little risk when you're making 30% return. It's just that your cash flow may be negative in the short term. I'd rather see people just with washes, right? So if my advice today is usually like, if you're going to invest in real estate, try to find a deal where it'll be a wash, so that you're not getting cash flow and you're not negative cash flow, because the whole way that you're going to make money in the long term in real estate is through leverage appreciation. That is the biggest thing that is going to increase your net worth, and net worth can always be converted to cash flow. So my whole goal for guys I'm coaching today is say, let's build your net worth as much as possible. And then later, if you want cash flow, we can always take net worth and turn it into cash flow in multiple ways, right? If you have $1 million, you could buy a property cash $1 million, and you can make, what's it like, probably like 50K a year off of that, right? Or, if you have, or we could even, if you want to be real conservative, we could take $1 million and we put it in a tax-free municipal bond and get like a 4% yield on it, right? There's or a dividend yielding blue chip stock, right? We can always take net worth and convert it to cash flow. So don't focus on cash flow. A lot of real estate investors focus on cash flow. The only reason you would do that is if you're going to retire, like you want to quit your job and you want to live off the cash flow. But if you have income coming in and you're going to run a business, you're going to continue to have income coming in, stay leveraged, increase your net worth, and to the point that you actually want to exit.
Yeah. That's interesting. What would you recommend? So for example, for me, I'm thinking about trying to do like a duplex. And if you've heard of house hacking, buying one side of it, and then, but in that scenario, it would have to cash flow. Do you recommend just avoiding that overall and waiting until you can put, a good enough down payment and just using it to increase your net worth? Or is that, would you advise house hacking?
I mean, it's just a way of hand. Like, so here's kind of my whole thing on the house hacking thing, that I don't think it makes a huge amount of sense. There's a small advantage that you get to it, right? So the way I look at investment is that you have to have two hats when you're a real estate investor, or as far as like buying your own property, right? The one hat you wear is the investor hat. The investor hat says, is this a good deal when I look at the cash flow, when I look at the profit and loss statement of this property, right? Is this a good deal to buy?
Mm.
The second hat you put on is the renter hat, and you say, is this a good deal for me to rent? And what is a good deal for you to rent? It means that it's not too big, not too small, right area, right, that you would pay for, that you'd rent. And if those two things line up, then you should buy the house that you rent, right? So house hacking falls into that. So what I mean by this is that the only advantage that you get, right? So the way I look at it is, let's say you're doing a house hacking where you buy a duplex and you live in one side. What I see it as this, I see it as you bought a duplex as the investor, okay? You rented one side out to an unknown tenant, and you rented another side out to the perfect tenant who pays the rent on time every single time. And the only other thing that you've gotten out of it is a slightly lower interest rate because it's an owner-occupied property. But other than that, you could have bought that duplex, okay, rented both sides out to other tenants, and then taken the rent that you got from one of the sides and just rented somewhere else for cheaper if that wasn't the place for you to live. So a lot of people, what they'll do when they house hack is they'll buy more house than they would actually rent. So whatever you live in, you have to say, whatever I would have rented it out for, that's the rent you're currently paying, if that makes sense.
Yeah.
And so if you house hack and you live in one side duplex, and let's say that you could have rented that duplex out for $1,300 a month, okay?
Yeah.
So if you're living in it, you're effectively paying $1,300 a month rent. But if you could have lived somewhere else in the same city, and you would have had a smaller place and you would have paid $900 a month rent, then you wasted $400 a month. You're paying extra, right?
Yeah.
Even though it's paying it to you, it would have been better in that scenario to rent it to someone else, right? Get the $1,400, take $900 of the $1,400, pay your rent, and have put $300 in your pocket. That would be a better choice. So that's why I'm not huge on the house hacking thing. It's the only thing, like I said, advantage you get is that you get a slightly lower interest rate because it's owner occupied, and you get a tenant that pays the rent all on time, all the time. It doesn't destroy things. But other than that, there's no magic to it. Unless I'm missing something, but I've never, that's how I look at it.
Yeah, that sounds pretty rock solid to me. Awesome. Thanks for that. Yeah. I really am trying to figure out the most effective way to get to that, financially independent area. And to me, one of the most intriguing ways anyways was like taking care of that rent bill. But what you're saying makes a lot of sense, because you can, actually net more if you were to do it that way.
And I bought the first fourplex I bought. I lived in one of the units for a year to get the lower interest rate, because I wanted a 1/4 point less interest rate. I was like, I'm willing to live in the unit to do that. So that was the plan. And then I moved out.
Cool. As far as the money that you've made from the courses you were doing in real estate, was it all going into real estate, or did you get into the stock market at all?
There was a period of time where I played poker and where I got into the stock market. So, and surprisingly, they're almost the same exact thing. They're almost the exact same skill set, right? Like it's amazing how uncanny it is that those things are so similar, because the key things to poker and to options trading, at least like complex options trading, is bankroll management number one and emotional management number two. And so I did trade. At first I traded, regular trading, stochastic type of trading. I tend to be a random walk type of person that believes that it's really hard to beat the market doing that. I mean, it's very, very small percentage of people ever do, and a lot of it is just law of large numbers and luck. If you have 1 million people doing it, some person's going to get lucky 15 times in a row, right? There's going to be odds say that will happen with all their picks, right? So, in fact, Nicholas Taleb, I always figure out say his name in the wrong order, whatever. Anyway, he wrote a book called The Black Swan. Also a really good book called Anti-Fragile. He's written a lot of really good books, but he talks about, in his book, he gave an example. He's like, what if you have this guy and he sends 1,000 people a letter in the mail, basically, and he's like, and he sends 500 of them this pick and 500 of them